While the national headlines are talking about the housing market that's cooling but stable, the real story is buried in the fine print of Ontario's mortgage data. There's a dangerous split happening right under our nose. A divergence between what the rest of Canada is seeing and the financial nightmare that's quietly unfolding for the homeowners across the Toronto and the GTA. These aren't just numbers, they are warning signs. There are specific charts and data points you won't see on the nightly news that reveal a silent crisis about to get very, very loud. What they show is a perfect storm of economic pain and policy disasters that go way beyond simple interest rate hikes. And I've been saying on this channel for months, the pressure building right underneath the surface was bound to show some cracks. Today, we're looking at those cracks as they spread. Let's start with the most critical piece of data, the one that's hiding the real story. According to a recent report from Canada Mortgage and Housing Corporation, CMHC, the national mortgage delinquency rates, that's the people falling behind on their mortgage payments, actually decreased in the second quarter of 2025 for the first time in 3 years. Landing at just 0.22 on the surface, that sounds like good news. It suggests stability. But the national number is a mask. It's hiding the regional disaster. Because in the very same report, we see the truth. While the rest of the Canada improves, Ontario mortgage delinquency rate climbed to 0.23, pushing it above the regional average for the very first time over a decade. Let that sink in. The economic engine of Canada is now performing worse than the country that is supposed to be leading. And you zoom in on the epicenter of this crisis, Toronto, the numbers get truly alarming. Toronto's mortgage delinquency didn't just climb, it exploded. It jumped from 0.15 in the second quarter of 2024 to 0.24 in the second quarter of 2025. That's a staggering 60% year-over-year increase, heading a level the city hasn't seen. While the rest of Canada breathes a sign of relief, Toronto is suffocating. This isn't just a random blip. This is a clear data-driven signal of the extreme and localized financial stress. It's divergence that proves Ontario, and particularly the GTA, is on a completely different path and much more dangerous path than the rest of the country. The question is, why? Part 1 of the answer relies on a huge financial shockwave that is only just the beginning to hit homeowners, the mortgage renewal crisis. The recent Bank of Canada laid out its stark terms. Roughly 60% of all mortgage holders in Canada are set to renew in 2025 and 2026. For the majority of these homeowners, especially the 40% who took out a 5-year rate mortgage back in 2020, 2021, the payment shock will be brutal. They locked in at a record low, some below 2%. Now they are facing renewals at significantly higher rates. The Bank of Canada's own analysis states that these homeowners face an average payment increase of about 15% to 20%. Let me translate that for you. That's an extra $5,000 or more per year just to keep the exact same home. But this payment shock isn't happening in a vacuum. It's happening at the exact moment the job market in Ontario is showing signs of trouble. In October 2025, while the national unemployment rate was 6.9%, Ontario was significantly higher at 7.6%. And again, zoom into the GTA and it gets even worse. The unemployment rate in the Toronto region for October was a staggering 8.9%. So you have hundreds of thousands of people facing the biggest payment shock of their lives, and at the same time, the risk of losing a job is higher than almost anywhere else in the country. It's a vice, and it's tightening. Every single month, more families are being squeezed from both sides. Their incomes are being less secure while their single biggest expenses is exploding. And it's not just mortgages and jobs. The delinquency rate on a non-mortgage debt like credit cards and car loans is also flashing red. In the third quarter of 2025, Toronto's non-mortgage delinquency rate spiked to 2.27, a nearly 20% jump year over year. That's what a financial stress looks like. People are falling behind on their credit cards, their car loans, because their mortgage is eating up every last dollar. They are being forced to choose which bill to pay, the credit cards or the mortgage. The data shows they are increasingly unable to pay any of them. Let's move away from the percentages for a minute and talk about real people. Imagine a family who bought an average detached home in the GTA in 2020. They were told it was a safe investment, the only way to build wealth. They secured a 5-year fixed mortgage at a rate of maybe 2.3%. Their mortgage was manageable. Now it's late 2025 and that dreaded renewal letter is in the mail. That 2.3% rate is long gone. They're now looking at rates closer to 4% or even higher. That 15 to 20% payment increase the Bank of Canada warned about isn't an abstract statistic for them. It's an extra $4, $5, or even $600 disappearing from their bank account every single month. What does that mean in real life? The family's vacation? Cancelled. The RSP contribution for their kids? They stop. It means a growing card balance just to keep groceries on the table. Now, what happens if one of the parents get laid off, becoming another statistics on Ontario's rising unemployment numbers? Suddenly, they face a 20% jump in their biggest cost with a 50% cut to their household income. How long can they last? 1 month? 3 months? At what point do they become one of those delinquency statistics? At what point does the dream of home ownership, the one that they were sold, become a financial nightmare they can't wake up from? This is the human story behind the charts. This is the real collapse. It's just not about house prices. It's about the financial ruin of thousands of families who did everything they were told to do, only to be trapped by a system that was never built for their success. So, what are all these pressures doing to the market right now? The data for 2025 shows a market that is cracking under the strain. And the GTA new listings were up 2.7% year over year, but sales plummeted, dropping 9.5% compared to last year. More supply, less demand, that's a classic recipe for a buyer's market, and it's putting serious downward pressure on prices. The average selling price in the GTA was down 7.2% year over year to just over $1,054,000. Detached homes saw their average price fall 7.3%, and the average price for condos dropped 4.9% to around $660,000. But don't let anyone tell you this is a soft landing. A soft landing doesn't come with a 60% explosion in mortgage defaults. A healthy correction doesn't happen while the job market is sputtering and a massive wave of payment shock is still building. What we are seeing is not a collapse in the prices, not yet. What we are seeing is a collapse in the financial health of the homeowner. That's the hidden crisis. The prices are just a lagging indicator. The real story is in the delinquency rates, the unemployment figures, and the sheer number of people who are about to find out their mortgage is unaffordable. As I've been saying on this channel, you have to look past the headlines. You have to follow the underlying data, and that data is crystal clear. The foundation of Ontario's housing market is weaker than it has been in more than a decade. What we have brewing in Ontario is a perfect storm. We have economic pressures from the most aggressive rate hike cycles in modern history slamming into a massive predictable wave of mortgage renewals. We have a regional job market that is crashing, creating a real income anxiety. The split between Ontario's rising delinquency and the stable national picture isn't an accident. It's the result of all these forces hitting the most expensive, most leveraged market in the country the hardest. This is the data that they won't show you on the news, because it's the story about a regional crisis that could cause much wider financial instability. The dream of home ownership is becoming a financial nightmare for a growing number of families, and the numbers show this is just the beginning. If you're a homeowner trying to navigate this uncertainty, A buyer who's seeing opportunity here, or a seller who needs a data-driven strategy in this market? The time for guessing is over. You need a clear, fact-based plan. Book a free, no obligation call with me at 416-845-9872. We can walk you through what this data means for your specific situation. And if you want to stay ahead of the curve and get the analysis you won't find anywhere else, make sure you subscribe and hit that notification bell. The market is changing fast, and we will be here to break it all down for you every step of the way. Until next time, see you soon.